Have you ever wondered where money comes from? It's a question that has puzzled many. The answer lies in a fascinating process called money creation. This process involves central banks and commercial banks working together. This essay will unravel the secrets behind this seemingly magical process. We'll explore how central banks like the Federal Reserve control the money supply. We'll delve into the role of commercial banks in creating money through lending, and we'll examine the impact of the digital revolution on money creation. Join us as we demystify the fascinating world of money creation. Central banks play a crucial role in our financial system. They are often seen as the guardians of the monetary system, ensuring that the financial framework within a country remains stable and secure. These institutions are pivotal in maintaining the trust and confidence of the public in the nation's currency and overall economic health. They are responsible for ensuring the stability and integrity of a nation's currency. This involves a range of activities, from managing inflation to overseeing the country's money supply. By doing so, they help to prevent economic crises and ensure that the economy can grow steadily. One of their primary functions is managing the money supply. This is a delicate balancing act, as too much money in the economy can lead to inflation, while too little can result in deflation and economic stagnation. Central banks must constantly monitor economic indicators and adjust their policies accordingly. This means controlling the amount of money circulating in the economy. They achieve this through various means, such as setting interest rates, conducting open market operations, and adjusting reserve requirements for commercial banks. Central banks don't achieve this through simply printing more money. Printing money without backing can lead to hyperinflation, which can devastate an economy. Instead, they use more sophisticated methods to influence the money supply and ensure economic stability. Instead, they employ a variety of sophisticated tools and mechanisms. These tools allow them to fine-tune the economy and respond to changing economic conditions. For example, by adjusting interest rates, they can influence borrowing and spending behaviors among consumers and businesses. These include open market operations, reserve requirements, and interest rate adjustments. Open market operations involve buying and selling government securities to influence the level of bank reserves. Reserve requirements dictate the amount of funds that banks must hold in reserve and not lend out. Interest rate adjustments can either encourage or discourage borrowing and spending. By carefully manipulating these tools, central banks can influence economic activity. They can promote growth, control inflation, and ensure that the financial system remains robust. Their actions have far-reaching implications, affecting everything from mortgage rates to the cost of goods and services, and maintain overall financial stability. In doing so, they help to create an environment where businesses can thrive, jobs can be created, and the standard of living can improve for everyone. Central banks truly are the guardians of the monetary system, working tirelessly to ensure a stable and prosperous economy. Open market operations are a key tool used by central banks to manage the money supply. This involves buying or selling government securities in the open market. When a central bank wants to increase the money supply, it buys government securities. This injection of funds into the banking system increases the amount of money available for lending. Conversely, when a central bank wants to decrease the money supply, it sells government securities. This removes money from circulation, effectively tightening the money supply. Open market operations are a powerful tool for influencing economic conditions. Reserve requirements are another important tool used by central banks to manage the money supply. These requirements mandate the percentage of deposits that commercial banks must hold in reserve. This reserve cannot be lent out. It serves as a safety net to ensure banks can meet withdrawal demands. By adjusting reserve requirements, central banks can influence the amount of money available for lending. Lowering reserve requirements allows banks to lend more, increasing the money supply. Raising reserve requirements has the opposite effect, reducing lending and contracting the money supply. Section 5: Interest rates, a powerful lever for central banks. Interest rates are a powerful lever that central banks use to influence economic activity. By adjusting these rates, central banks can either stimulate the economy or cool it down, depending on the current economic conditions. This tool is crucial for maintaining economic stability and achieving sustainable growth. The central bank sets a target rate, known as the federal funds rate in the United States. This rate is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight. It serves as a benchmark for many other interest rates in the economy. This rate influences other interest rates throughout the economy, including those for mortgages, car loans, and business loans. When the federal funds rate changes, it sets off a chain reaction that affects the cost of borrowing and the return on savings. When a central bank lowers interest rates, borrowing becomes cheaper. This encourages businesses to take out loans for expansion and consumers to spend more on goods and services. Lower interest rates can lead to increased investment in infrastructure, technology, and other capital projects. This encourages businesses to invest and consumers to spend, stimulating economic growth. Increased spending and investment can lead to higher employment rates and improved economic conditions overall. However, if rates are too low for too long, it can lead to excessive borrowing and potential financial bubbles. Conversely, raising interest rates makes borrowing more expensive. This can slow down consumer spending and business investment, which can help to cool off an overheating economy. Higher interest rates can also attract foreign investment, strengthening the national currency. This can help to curb inflation, but may also slow down economic growth. Central banks must carefully consider the timing and magnitude of interest rate changes to avoid triggering a recession while keeping inflation in check. Central banks carefully adjust interest rates to achieve a balance between growth and stability. They monitor a wide range of economic indicators, including employment rates, inflation, and GDP growth, to make informed decisions. The goal is to create a stable economic environment that fosters sustainable growth and minimizes the risk of economic crises. Section 6. Commercial banks, the engine of money creation through lending. While central banks play a vital role in managing the monetary system, commercial banks are the primary engines of money creation. They achieve this through the process of lending. When a bank issues a loan, it doesn't simply hand over existing money. Instead, it creates new money electronically and credits it to the borrower's account. This new money enters circulation and increases the overall money supply. As borrowers repay their loans, the money is destroyed, reducing the money supply. Section 7. The deposit multiplier, a ripple effect in the economy. This concept is fundamental to understanding how banks contribute to the expansion of the money supply in an economy. It all starts with a single deposit, which sets off a chain reaction of lending and redepositing. The deposit multiplier effect amplifies the impact of money creation through lending. When a bank receives a deposit, it doesn't just sit on that money. Instead, it uses a portion of it to make loans to other customers. This process is regulated by the reserve requirement, which dictates the percentage of deposits that must be kept in reserve. When a bank receives a deposit, it must hold a portion in reserve. This reserve is a safety net, ensuring that the bank can meet withdrawal demands. The remaining amount, however, is free to be lent out to borrowers. This is where the magic of the deposit multiplier begins. The remaining amount can be lent out. When a bank issues a loan, the borrower often deposits the loan amount into their own bank account, either at the same bank or a different one. This new deposit then becomes part of the receiving bank's reserves, allowing that bank to lend out a portion of it as well. This loan then becomes a deposit in another bank, which can lend out a portion of it. Each time a loan is made and deposited, the money supply increases. This cycle of depositing and lending can continue multiple times, significantly amplifying the initial deposit. This cycle continues with each loan creating new deposits and further expanding the money supply. The deposit multiplier effect demonstrates the interconnectedness of financial institutions and how they collectively contribute to economic growth. It's a powerful illustration of how money can move through the economy, creating opportunities and fostering development. The deposit multiplier effect illustrates how even a small initial deposit can have a significant impact on the overall money supply. By understanding this process, we can better appreciate the role of banks in the economy and the importance of regulatory measures that ensure stability and growth. This ripple effect is a testament to the dynamic nature of financial systems and their ability to transform individual actions into widespread economic benefits. Section 8. The digital revolution from cash to electronic money. The way we use and create money is undergoing a profound transformation. The rise of digital technologies and electronic payment systems is rapidly reducing our reliance on physical cash. Today, most transactions occur electronically. This shift towards digital money has significant implications for money creation. Central banks are exploring the concept of central bank digital currencies, or CBDCs. These digital forms of fiat money could offer greater efficiency, security, and financial inclusion. The future of money is digital. Section 9. Conclusion. Understanding money creation for a stable economy. Money creation is a complex but essential process that underpins our financial system. Central banks and commercial banks play distinct but interconnected roles in this process. Understanding how money is created is crucial for comprehending economic fluctuations, inflation, and the effectiveness of monetary policy. As our financial systems continue to evolve, so too will the mechanisms of money creation. By demystifying this process, we can make more informed decisions and contribute to a more stable and prosperous economic future.